This is InvestTalk. Independent thinking, shared success.
This is Brady from Columbus, Ohio. I wanted to get your take on Cooper Standard, stock symbol Charlie Papa Sierra. Got 500 shares. Just wanted to get your status on what you think the health of the company is and where you think it's heading based on fundamentals. Look forward to listening to the podcast. Thank you.
So Cooper Standard Holdings, Inc., ticker CPS, is a global supplier of systems for automotive components for cars, the automotive industry is what I was trying to say. And so they specialize in fuel and brake systems, and they have clients really all over the world. You see their fluid handling systems is about 47% of the revenue. Their sealing systems about 53%. So pretty evenly split there. Only 22% of the revenue, 22% comes from the United States, even though they're headquartered in Michigan. 31% from Mexico, 11% from China, 36% from other areas of the world. And so taking a step back and looking at this company from a high level, ignoring everything around us, it's about a $305 million market cap company, about $1.1 billion in debt. They have not made money over the past couple years, though they are projected to finally be positive once again this year, but they're pretty levered. Their interest coverage ratio is floating just above 1 at 1.17%. And so looking at that, I see an overstretched company whose cash flow is, yes, improving, whose profitability is coming back, but they've issued a lot of shares. They went from 16.8 million shares to 17.3. That doesn't sound like a lot nominally, but in terms of percentage, that's pretty high. Those have 6.62% short interest out there, and that's before today. So now we've taken a high look and say, well, looks relatively unstable. And with the exception of 2023, it's performed poorly. But now drilling in, understanding the announcement of automotive tariffs, 25% on imported cars, for a company whose 78% of their business is outside the United States, not so good. It was down 40 basis points today before the announcement. It's down an additional 3% or so in aftermarket trading last time I looked. So for now, given everything happening, and really given the position of its balance sheet, I'm going to have to say pass on Cooper Standard Holdings, Inc., that is ticker CPS. Let's keep things moving and get to a question from our InvestTalk YouTube question bank. While you're over there on our channel, I think we've gotten a lot of positivity in the comment section from listeners who really like the change we've had in terms of the format. It's really kind of like the old Goosebump books, if you remember those. You pick your own adventure. You can pick your own videos. What part of the show do you want to emphasize in your daily life? And so while you're over there, should you have a question that really sticks in your mind, just leave it there in the comment section of the InvestTalk YouTube channel, any video, and we will pick it up and we'll try to get to those as soon as we possibly can. And so this question came in a little bit earlier from our friend with a great name, JDude88. It says, MYRG, what are your thoughts on picking up MYRG based on the fundamentals? And also, what would your price target be? Now, MYRG is a specialty electrical contractor. They provide services for transmission and distribution networks, substation facilities, and industrial products across the United States and Canada. Had a pretty negative day on the day, down 6.20%. Year to date, it's down 18%. On the 3-month, it's down 21%. 52 weeks, down 28%. Sitting at about $120 a share right now. From a trend perspective, generally over the past 10 months, it's been negative, though just slightly negative. Looks like they reached a high of about $170 a share back in April of last year. Again, now trading at about $120. So definitely a downward trend from that perspective. Let's look at their balance sheet. Only about $120 million of debt on a $2 billion business. And they really don't issue that much shares. They don't pay a dividend. Their profitability, though, slipping. Their cash flow slipping. And so it makes sense that in the past 2 years, well, they've underperformed the S&P 500 by about 20% in 2024. They underperformed their industry by 36% that year. And now they're underperforming the S&P 500 and their industry by 16 and 8% respectively. And the main reason really is not just the slipping margins, but that revenue decline. They hit a peak in 2023, about $3.6 billion in revenue. It's down to $3.3 billion last year, projected to be $3.4 billion this year. Those margins, again, slipping from a high of about 3.4%. Was about 0.9% last year, less than 1%. Now it's supposed to grow again to 2.9, but still we're seeing slipping margins, we're seeing slipping revenue, and that's not something we really like to see. Overall, the trend is negative, not just in the fundamentals, but also in the price. And so for now, I think I would stick away from this company. It's got about 7% short interest out there. Again, had a very negative day today as well. Let's look at their breakdown real quick geographically. I mean, most of it comes from, again, the US and Canada, but trade tensions are getting higher. So for now, I would stay away from MYRG, that is MYR Group. J-Dude, thanks for watching. Let's dive in. We got plenty of time for one more question. This one is on Volkswagen. And it came from our iTunes review section. So when you take the time to leave a review and leave your question, we will get to those as soon as we can. This one from Barb in Brooklyn. Love Brooklyn. It's about Volkswagen. What are your thoughts on Volkswagen? Well, if you listened to the show on, when was that? Friday? We were talking about how difficult it is for cars to become global businesses. One of the reasons I mentioned was trade barriers. And so if we had answered this question yesterday, I would have told you the car business is a poor business to be in. And a lot of the times they lose money. A lot of the shifting dynamics really hurt the car industry. It's difficult to have a really positive, and I don't mean positive in terms of return, I mean stress-free investment experience in the car industry. And that's absolutely the case for Volkswagen as well. Now, diving into their fundamentals, they've slipped a little bit over the years. That is certainly the case. But I think the major thing here that we can't ignore is those auto tariffs that were announced today, right? Volkswagen is an international company. It is not based in the United States. 20% of its revenue comes from North America. A lot of it comes from Europe. You could stand to reason that maybe with these tariffs, Europe buys more European, right? That revenue percentage goes up. Certainly banding together in a trade war, that could be some positivity there. But overall, I don't really like investing in the auto industry, and certainly not at a time where the US is threatening 25% tariffs on international auto manufacturers. So for now, I would stay away from Volkswagen and honestly, any car company. Let's keep things moving to back into the InvestTalk voice bank. You know the number, 888-99-CHART.
Hey, Justin and Luke. This is Adam from Minneapolis. Love the show. Just real quick, wanted to get your thoughts on SEZL, ticker SEZL. They are a buy now, pay later payment processing company. So I get your thoughts on that one. And if you have any thoughts on the industry, I see both the pros and cons of it, especially as the consumer is tighter, how it would be helpful, but also the economy and the consumers are stretched out, won't have as much benefit from using that. So I just wanted to get your thoughts. Let me know. Thank you.
So SEZL is the ticker for SEZL. It is a buy now, pay later company, right? They offer installments for interest-free installments. They primarily operate in the US and Canada. And it's really been a trend over the past couple of years to move towards this buy now, pay over time model. Now, over the past 3 months, it's down 13%, year to date down 7%, but over the past 52 weeks, it's up 172%. Right? It IPO'd in the middle of 2023 at about $80 a share, dropped off a cliff. Now it's trading at about $200 a share. But I think you identified my main issue with buy now, pay later companies. These fintech companies haven't been through a recession, a lot of them. Affirm, Klarna, SEZL. And so they don't understand how their business model is going to operate in economic uncertainty when consumers are going to default on a lot of these payments, certainly before they default on more established loan companies. Because of that, a lot of risks. Consumer spending is contracting. And so for now, I would stay away from buy now, pay later companies.
This is Mike and Tracy. You guys have a wonderful program, very intuitive and learning, and so it's just a wonderful program. I'm also a client. I was wondering if you guys can speak a little bit about the annuities, the pros and cons. I know you've done that through the years, and I was just wondering if you guys can touch on that as well. Look forward to hearing your answers. Have a wonderful day. Bye.
Annuities. Something that you probably haven't heard a lot of positive comments about from me. And that's because generally annuity products are sold by people that get commissions and fees off of selling you those annuities. They tend to be expensive and complex. And I just think generally you can craft an investment portfolio that accomplishes the same goal as an annuity for cheaper and have more transparency. But let's talk about the pros and cons. Because there are some pros, right? One is guaranteed income. You know how much money is coming when. And that can be good if you're trying to plan and do liability matching, right? Another, tax deferred growth. You get principal protection. You can also have some custom options and riders that are put in that make the most sense for you. Now, on the con side, they're illiquid. If you're in an annuity and you need the money, there is likely to be a surrender fee, surrender charges, which can eat away at the money you've given to the annuity company should you need it. Public markets, very liquid. High fees, right? You can have limited growth. You have limited upside potential. I saw an annuity, one of our clients, where over the past 2 years, they returned about 10% a year in 2023 and 2024, which sounds good unless you know how the market returned in 2023 and 2024. And they're complex. There's a lot of terms that you may not understand. And I think one of the most important parts of investing and having an advisor and giving your money and your trust to somebody is transparency. And so again, overall, I think there are specific instances where annuities can make sense, but I just think that you can, in a more transparent way, craft a portfolio to accomplish the same goal, with also having the benefits of liquidity, flexibility to change should you need it. Thanks for the call. Moving along to another question that came in from the InvestTalk YouTube question comment section. This one on CORT, ticker CORT. It says, could you please look into Concept Therapeutics? I own some 4% of my portfolio, but it went down by 25% due to lawsuits related to generic versions of its one and only drug. Hold or sell at this point. Let's dive into Concept Therapeutics. Well, Concept Therapeutics is a $7.2 billion market cap company. It's up 130% over the past 52 weeks, up 13.34% year to date, 6.49% in the past 3 months, but down 2.07% on the day. Its high of about 83, it looks like, about 70, 72. It has since dropped from that down to about 57% over the past, down to $57 per share the past 7 months. Past month. I'll be fine. Take a look at the revenue. It has grown on a pretty solid clip from about $300 million in December of 2019 to about $675 million last year, projected to still be about $900 million this year. In that time, their margins, fantastic. 30% in 2021, 25% the next year, 21% the next year, 20% last year, and 25.5% next year where they're projected to be. Now, from a debt perspective, not much debt, about $7 million in debt on a $7 billion market cap company. This company is pretty solid from a balance sheet perspective, and they actually don't issue shares. So a lot of their business is run from internally generated profits, and with that growth and with those margins, that's to be expected. So let's boil down into this. Let's dig down into this and look at their relative valuation. About 25.5 times forward-looking earnings. 24.8 is the average over there. About 9 times book value, way above its 5-year average of about 5.8 times. The most alarming thing, short interest, about 17% out there. Now, I think the big issue is exactly what you said, right? It has its one and only drug, which leaves it exposed to a lot of risk on that one and only drug. And so even though it's clawed back a little bit, it was down to about below $50 a share. Now it's trading about $57 a share. It's very expensive. Price to book about 9 times. And so taking a look at that, it's price to cash flow of 34.9 times. Price to sales about 10 times. I think it may be ripe for a little bit of a pullback. Even though its profitability is solid, its cash flow is solid, its balance sheet is solid, the market is signaling to you with that massive short interest that it believes it's too expensive. I believe it is as well. That is CORT. Took us a while to pull it up, but we got there. Concept Therapeutics Incorporated. For now, I don't think it's necessarily a sell, but I think it's at least a hold. Wouldn't put any more. That is Concept Therapeutics, CORT. Let's keep things moving and dive into an interesting topic today. And that is on some backlash from the U.S. oil industry. And that's because the president's pledge to lower energy prices and impose these tariffs is sparking some backlash from the U.S. shale industry. A survey out of the Dallas Fed, which surveyed, about 300, 400 companies, 130 oil companies, nearly a third, said their business outlook has worsened in Q1 of 2025. And the reason why, falling oil prices and chaotic policy. And so these same executives are warning that tariffs, which act as an input cost to them, as well as a pretty blatant push for $50 oil to tame inflation, threatens production viability. One respondent said, "Drill, baby, drill is a myth." And so the industry as a whole is starting to slam the administration for the unpredictability of its policy moves. So let's think about why, right? We as consumers would love cheap gas, would love cheap energy, right? Energy is an input on every single product. And so if prices are falling, maybe prices of end goods fall as well. But with the echoing of this $50 oil target, not just from the president, but from his trade advisor, Peter Navarro, as well, you have to think of it from the energy production side, right? Energy production within the U.S. thrives and relies on constant reinvestment, right? Lower prices means less drilling. Lower prices means opening fewer wells. In the long run, lower prices can lead to lower supplies. When demand peaks up, you can have price spikes. And so, as with anything, we already talked about this on the top of the show, right? What is the market like? Sure, the market prefers some policy over others, but more than anything, the market likes direction and the market likes certainty. And that's what these public companies want as well. The uncertainty, they say, is really causing them to hit a pause button in terms of new well openings, new drillings, which can, again, down the road, really hurt supplies. In fact, analysts are saying that the fallout could reverse recent U.S. production gains that we started to see in 2018 that has moved the U.S. to be the largest producer of oil, and reverse a lot of those gains and really weaken our fossil fuel dominance. So the bottom line, industry insiders are starting to really sound an alarm bell about the administration's rhetoric, about tariffs, and how that clashes with their energy goals, but the viability of U.S. oil production. More than anything, I'm going to emphasize it again, clarity, clarity, clarity is what the market wants. Clarity, clarity, clarity is what we as investors deserve. Let's keep things moving, dip into the InvestTalk voice bank and play this question that came in from a listener earlier today.
I was wanting to know your thoughts on Sibanye-Stillwater. SBSW is the ticker symbol, but I don't know if I should buy more or if they're in a lot of financial trouble or why it's been going down. I know it's kind of a volatile area, but should I sell it and get out of it or should I buy more? Thank you. Love your show. Bye.
Well, let's take a look at SBSW is the ticker. It is an ADR for a company that is headquartered outside of the United States, South Africa. In fact, it is Sibanye-Stillwater Limited sponsored ADR. It's a multinational metal and mining processing group based in South Africa. It's one of the world's largest primary producers of platinum, palladium, and rhodium. It's also a top-tier gold producer as well. Now, taking a look at its geographic exposure, about 75% of its revenue is coming from South Africa. 21% of its revenue is coming from the United States. Year to date, it's up 31.82%. It's up 25.36% on a 3-month basis. One of the reasons why, most likely, metal prices doing pretty well. Commodity prices have been volatile, but gold specifically has been doing pretty well. But as with any mining company, you're going to experience a lot of volatility. And taking a look at their chart, that's exactly what you're seeing, right? They went from trading at $3.10 back in September to almost $5.50 back in October, then back down to $3.10 again, up to $4, down to $3.10, now at $4.5. But this is what you have to expect. This is the business of mining. And so revenue, all over the place. Profitability, all over the place as well. From almost 20% in 2021, down to negative 33% in 2023, negative last year again, positive this year. This goes back to uncertainty, right? Commodity traders are less than enthused, we shall say, about uncertainty that has been affecting the volatility of commodity markets, specifically metal markets. Tariffs as well, large effect. And so right now it's trading at a forward-looking earnings about 9 times, well above its 5-year average. Price to book, almost at book value. It's trading at 1.3 times below its 5-year average. Price to cash flow, 5.1 times. Price to sales, 0.5 times. I wish I had a larger breakdown of how much of this company's business is specifically from gold. Gold obviously doing well recently with market uncertainty. But I think if you can't stomach the volatility here, which a lot of investors can't, mining might not be a proper place for you, right? This isn't a big miner of copper. This isn't a big miner of industrial metals, right? They do have a little bit of copper, but they're really known for their production of platinum, palladium, and rhodium, and being a top-tier gold producer. So given the metals that it's mining, I think for now I would stay away. There's a lot of volatility, a lot of uncertainty. Look to the commodity markets. They would tell you the same thing. Thanks for the call. Now it looks like we may have time to at least start another question, which we may have to answer after the break. Let's see if we can get another voicemail in right now.
I just had a question about a stock. It's called Welltower, WELLTOWER, and the ticker is WELL. I know it's a REIT. I was just wondering if it's a LLP or a LLC, or if you get a K1 for it. Listen for the answer to the show. Thank you.
So let's take a look at Welltower Inc. That is ticker WELL. Just pull it up on my other screen on this data tab as well. Bear with me, everybody. And so Welltower Inc. is a healthcare infrastructure company, invests in senior housing operators, post-acute providers, and health as well. It's a fairly large company, right? $98 billion market cap. Its revenue growth, pretty solid at 9.3% on an annualized basis over the past 5 years. And its profitability looks pretty good too. Up from 2.4% in 2022, 11.9% last year, projected to be 11.9% this year. And so when we get back from the break, we will dive more into this name. We'll look at its relative valuation, which is not price to earnings for these types of names. It's more price to funds from operation, how that's looked over the past 5 years, and try and figure out if you invest in this name, are you going to get a K1? For the break, we were diving into Welltower Inc., ticker WELL, which is a REIT that really focuses on senior housing and post-acute communities, as well as outpatient medical facilities. Now, again, it's a large company, about $95 billion market cap. They don't have a lot of debt, only $16.7 billion as of the end of last year and as of the most recent quarter. But it looks like they finance their operations really through the issuance of equity rather than debt. They've had a lot of growth from about 400 million to 650 million in shares outstanding over the past 5 years. Pay a solid dividend, about 1.81% is where it is now, lower than it's been over the past 5 years, the peak of which was 4.6 in 2020. And so from a price perspective, it doesn't look too scary to me. Now, it outperformed its industry each of the past 3 years, 2025 inclusive. Year to date, it's up 18.9%. It's outperformed the industry by 18%. It's up 39.8% last year. Outperformed the industry by 39%, up 37.8% in 2023. Outperformed the industry by 31%. Really outperformed the industry in 2022 as well, even though it was negative. And so a lot of that is the growth in the business, right? Financing through equity to purchase properties in the US, in Canada, the UK. The revenue has doubled since 2021. And it's in a line of business that is growing. The population of most countries, especially the United States, is aging. People are entering retirement. Senior care facilities, medical facilities, frankly, are good businesses to be in. That's why it's up 18.9% year to date. So from a relative valuation perspective, it's obviously a little expensive. It's price to funds from operation, 29.1 times relative to 21.9 times over the past 5 years. A little expensive. Price to book value, 2.9 relative to 2. And so I like the business. I like the line of business it's in. I like the stream, the revenue stream. I like the revenue growth. I like the profitability, which is went up 5 times since 2022. I like all that. It's a little expensive, but for a good reason in terms of how it's outperforming the market and the industry over the past 5 years. And so I like the name. I'd maybe wait a little bit, maybe DCA into it. But the other part of your question, which we were able to look into a little bit, is would you get a K1, right? A K1 is a tax document that you may get based on a partnership organization. And from what I can tell, it restructured in 2022, meaning you would get a 1099 and are unlikely to get a K1. Again, I don't want to put you in a disadvantageous tax position, but from what I can tell, you would get a K1. Please follow up with a tax expert or look more into its structure just to confirm that. Thanks for the call. That is Welltower Inc., ticker WELL. Now, before we head off for the day, I want to talk about an interesting story I saw, and that's about the concert ticket industry. Live Nation expects a record-breaking result in 2025. Ticketmaster app traffic surged 70% year over year in February, which is interesting. We have been talking a lot about how consumer spending is being dampened, and it's really been propping up the economy for a while. So why are concerts doing so well? Well, historically, concerts outperform recessions. One of the reasons why is advanced bookings help to cushion some of the downturns, right? If you're buying tickets 6 months ago for shows that are now, recognizing that revenue, that can be a benefit to you. Concerts are also pretty affordable compared to NFL games, which would be hundreds of games in Los Angeles. When I tried to go to an Eagles game, it was like $400 for not good seats. There's also a lot of global tour flexibility, right? Artists can reroute shows because of demand. And so that has helped to sell tickets as well. But ironically, the most interesting part here is the part we all hate. And maybe it's a little just desserts here. Ticket scalpers. They act as shock absorbers. They are buying a lot of tickets on the primary market and selling it on the secondary market. And so if you're buying a lot of advanced tickets and people are trying to buy it from you as the shows become closer and they no longer have money, who's losing there? It's not the artists. It's not Ticketmaster. It's not Live Nation. It's those scalpers. In 2019, scalpers earned $1.3 billion in profits. And so in a recession, scalpers are going to bear the brunt. Bottom line, the economy slows. The music doesn't stop. It's ticket resellers, not performers, not production companies, not ticket companies that are losing money who may feel the squeeze. I'm Luke Herrera. This completes another InvestTalk program. We thank you for listening and encourage you to tell your friends and family members about our free podcast downloads at iTunes, Spotify, Google Play, as well as our YouTube series over on YouTube at InvestTalk with 2 T's. Remember, we can help you better understand your risk number, take a look at your portfolio for you, maybe give you some direction, maybe bring you aboard as a client, where we build full financial plans for our clients, as well as helping out with their 401ks. If any of that sounds interesting, any of it at all, head over to investtalk.com and hit the portfolio review button. It is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.